Short video to provide an example of how I use the 20 simple moving average to enter the market. Now you're looking at a chart of the S&P 500, and the day here is Wednesday. That's important because Wednesday is the middle of the week. So you have Monday, Tuesday, Wednesday, and then Wednesday becomes the middle of the week. And Wednesday typically gives you very nice reversal patterns because it's at the middle of the week. Okay. Now on Wednesday, this particular week, there was no news on the 8th of May, 2024. And so you've got to ask yourself, if a market's breaking out, why is it breaking out? Is that a false move? So there's a couple of things that I want to go through in this video. Number one, this market. So if you look at this dotted line, that is the low of the previous day. So that's important as well. Okay, when a market breaks out to the low of a previous day, as you can see here on the S&P 500 in last night's trading, that triggers other time frame traders into the market. That essentially triggers people, retail traders who like to trade breakouts to the downside. Okay, they have their orders in the market that get triggered when a market breaks the low of a previous day. Now, any move prior to the session, in my experience, is false. Okay, so if I see this move going down, it's prior to the session, and we also have a break of the previous day's low on a day where there's no news on a Wednesday, then I typically consider that as a false move. I'm looking for the reversal, and I use the 20 simple moving average, which is a red line you see on the screen. Okay, the time is very important when you use this. So we can see that the market has reversed from the bottom there. Okay, now let me talk also about these lines you see in the chart, these horizontal lines, in particular these red ones. Okay, these are pre-drawn on my chart. Okay, and they represent key institutional level price points. Okay, so this is 5170, this is 5180, and this is 5190. Okay, so that there is a 100 pip box between those two horizontal lines. Okay, that means this here is also a 100 pip box. Okay, now notice that the market has come down into this bottom 100 pip box, and it doesn't go all the way, right? It stops, and so that is a stop hunt into anyone that may have been long this market, maybe from the previous day. And typically those stop hunts are 50 pips. And you can see that box there is 50 pips, right? So each one of these quarters is 25 pips. Okay, that's what makes this a 100 pip box. Okay, this here is 25 pips. This here is another 25 pips. Okay, that makes it 50 pips in that range. And then you have this here, that's another 25 pips, and then this is another 25 pips. Okay, so that's how we measure the 100 pips range, and that's how it's broken down into quarters. I can very easily see without having to work out the numbers that those two boxes is 50 pips, and so this is essentially a stop hunt and a reversal. Okay, so let's now jump to this 20 moving average, this 20 simple moving average, because it's a red line you can see going through my chart. So what I like to see is at the right time, I want to see a reversal, okay, and that reversal for me is a push back up into the simple moving average, and then a push back down into the average, and that's where I'm looking to go long if it's a reversal from a move down on the left. And what I want to see, so I want to see that at 9:30, that's the key time that I trade, New York time, 9:30 a.m. This yellow box you can see on my chart is the New York session. Okay, so I trade the New York session, and in particular, I like to trade the 9:30 a.m. equities market open. Now, if I put my cursor on this bar here, right down the bottom, that time, so this cursor here, the first this is a 5-minute chart, the first candle that goes through that moving average occurs at 9:30. Okay, don't look at the time on the chart there. That's the broker server time. Okay, I know that's 9:30. I'm telling you that's 9:30. Okay, and then you can see immediately after that we get this push back down into the moving average. Okay, so that's what I want to see. I want to see all that happening inside that 9:30 to 9:45 candle. The push back down is right on 9:40. Okay, let me make this bigger. Make sure you understand that clearly. Okay, so we are coming down. Okay, we don't make a new low, meaning that we stop. Okay, we stop going down and start to go up. And that's the first time. Right at 9:30, isn't that magical? Right at 9:30, we go through the moving average for the first time. That's what I want to see. Okay, and then I want to see a continuous movement because I've missed it. I want to see something coming back into the moving average, and that's where I want to go long. Okay, if this is a reversal to the long side, I need to just see all of that between the 9:30 and 9:45 candle. Okay, now this here is a very, very strong candle where you've got the open of the candle and then this immediate retracement down to at least the high of its previous candle, which is right there. Okay, that's the high of its previous candle there. Now that is known as an immediate rebalance. Okay, and so when you have that, when the market opens up, or the bar, this bar opens up and it's high, retraces, and then immediately goes back up, then you can expect the next bar or even that bar itself to be very strong, as we see, and that is another good indication that we are headed higher. Okay, and you can see here that that was a very nice move in the S&P 500. Nice false move down, okay, and that's prior to the session. We stop going down, okay, we don't make a new low, and right on 9:30, the magical time, we go up, and that's the first time we go through that 20 simple moving average, and then at 9:40, we have that candle going down, and that candle itself, which is not that relevant, is also a strong candle in terms of its structure. Okay, but that's not that important. So long as you get this push up and a push back down, then high probability we will see high prices. Now you've got to take everything I've said into consideration. This is on a Wednesday, which is the third day of the week. We have broken down prior to the New York session. We've broken and taken out the low of the previous day. We are dumping down. Okay, and right on that 930 to 945 candle, we've gone back up into the 20 simple moving average and then back down. Okay, and that basically puts pressure on anyone that's made long from that bottom. Okay, you want to see that, and that's where I would potentially look for a long setup. Okay, so that's potentially where I would look for an entry, and target will be to whether that dump started back up through the highs there prior to that dump. Okay, and it's a nice 200 pip move from that entry. Okay, so this move from entry to back up to the highs there is 200 pips. We know that because, as I've said, each one of these boxes between these red lines is 100 pips. So we can see there's two inside of two of those 100 pip boxes. Okay, so you'll stop once you have entered. The risk based on your own risk tolerance levels will be at the low of that 930 bar. 930 should essentially hold, and you don't want to see the market come back into that low. In fact, you don't really want to see the market come back into back inside the other side of that moving average. Okay, so timing is important. What's happened prior to the New York session is important. Breaking through that previous day low is important. Okay, the day's important, being Wednesday, the third day of the week, the middle of the week. Okay, third day of the week. So all of those things are what make this a great setup. All of those things need to be taken into consideration. Okay, hope the video was useful. Go back and you've got to really go back and test this. Go look at it on your own charts. Go back many weeks, months, years, and have a look at the data. Test it for yourself, make sure you understand it. So don't just watch this video as entertainment. It's for you to understand what to look for and how we can use price action behavior, okay, to determine future price movement in any market. So you've got to go back and look at this on your own charts. Firstly, go back and look at it on your own charts and identify what I've identified here so that you can clearly mentally take a snapshot of that picture, okay, and then go back to previous days, previous weeks, previous months, previous years, other markets, and go back and find these patterns that I've just outlined, this pattern specifically that I've outlined, and you'll find that they repeat. And so you've got to go and be confident with those, learn them, study the charts, okay? Hope the video was useful. I'll talk with you in a future video.